silver falls by $5, I'm out $5 million. But the LBMA is full of crap.
Where are we going to see the end of the year gold and silver numbers?
Michael Oliver's saying $500 silver by this summer.
He's saying 300 to 500 by the summer.
The People's Liberation Army is importing it. Sovereign Wealth Fund, acting on behalf of the PBOC, is importing it. It isn't counted.
Last week we did see silver make a surge, $89. I mean, we were teetering on 90, and then bam. Smoked us, right?
But there is someone buying it.
Yeah, 10-year bust through resistance.
If it gets through 5%, then all hell's going to break loose. But if it gets through 5%, that's when you saw Silicon Valley Bank and Signature Bank fail. You look at the amount of bond holdings in U.S. Treasuries Cayman Island holds versus their GDP, it's laughable. It's a big hedge fund.
And gold's like 6,000 area. And I think longer term silver, 200 is very doable.
Right.
It wasn't until Volcker raised rates to 18%.
Yeah.
That he was able to squash the gold bull. Can you imagine what 18% rates would do to this economy?
Oh, my Lord.
Doug Casey put out a great article. The 10-year Treasury is like the heartbeat of the global financial system.
I am your daddy, 1776. Has anyone audited the COMEX like the audit Fort Knox? Maybe COMEX is really empty.
Well, it's interesting. I mean, a lot of people say their numbers are crappy. I want to read to you something here, which is not COMEX, but it's London. So it says, Goldman Sachs also observes that the London vault inventories continue declining while the official UK export data no longer reflects those outflows. According to the bank, the discrepancy likely represents sovereign gold movements increasingly disappearing from trade statistics altogether. In other words, someone is getting gold delivered more than we know. This suggests that some portion of sovereign transactions is no longer being recorded. To correct for this, Goldman adjusted its nowcast methodology by adding the gap between London vault outflows and the UK net exports as an estimate of unrecorded sovereign demand. The revisions were substantial. January estimates rose from 12 tons to 66 tons, while February increased from 2 to 41. So what they're basically saying is that the LBMA is full of crap, that their numbers are not true. They're not reporting the outflows. When measured with the import-export numbers, there's a gap, and those are unreported purchases. The reporting by the sovereign nations is voluntary with the IMF. The World Gold Council estimates things. If the People's Liberation Army is importing it, or a sovereign bank, like a sovereign wealth fund acting on behalf of the PBOC is importing it, it isn't counted. So a lot of metal is being purchased and taking possession from out of the UK that we know of that isn't adding up.
Vault numbers can look stable while actual physical trust quietly erodes underneath them. Andy Schectman notes the sharper issue is not price, but the widening gap between visible exports and disappearing sovereign demand. When estimates jump from 12 tons to 66 tons in one revision, reporting confidence becomes part of the risk itself. For long-term savers, opacity matters because institutional shortages usually become visible only after repricing begins. Next, Andy Schectman exposes why missing gold flows create a deeper contradiction than official inventories admit.
And I would argue, when you take a look at the CME group, who's had 4 glitches since Thanksgiving, should we really put too much faith in the numbers that they post? They count the eligible numbers in total vault holdings in the COMEX vaults, and a good portion of the eligible is not ever for sale. It's like, my one client who has 2 million ounces and 1,000-ounce bars in New York, she's not going to sell it into the registered category, at least not anytime soon, but they count it that way. So, it's all a bunch of nonsense. It's a great question.
It is a great question. All right, I got a couple of starred here, so hold on one second. And let's see. Jeff Robedine wants to know, will the 10-year bust through resistance?
Well, if it gets through 5%, then all hell is going to break loose. It's already, you can argue, more or less broken through resistance. But if it gets through 5%, that's when you saw Silicon Valley Bank and Signature Bank fail. I would expect to see the 10-year yield go much higher. And it will get to a point where the Fed will have no choice but to come in and monetize, which creates hyperinflation.
They're going to print and they're going to buy.
It's yield curve control. It's like you look at the massive increase of Treasury holdings in the Cayman Islands. Really, are we really supposed? You look at the amount of bond holdings in U.S. Treasuries that the Cayman Island holds versus their GDP. It's laughable. It's a big hedge fund.
Markets call it liquidity. But some of that inventory may never truly be available. According to Andy Schectman, counting eligible vault metal alongside total holdings can distort what investors assume is accessible supply. Pair that with repeated exchange glitches and a 10-year yield pressing near system stress territory, and confidence itself becomes tradable. That does not just affect traders. Savers tied to bonds, banks, and purchasing power inherit that instability quietly. Next, Andy Schectman reveals why rate pressure may contradict the illusion of orderly market depth.
Who is that hedge fund? Does it rhyme with Federal Reserve? Maybe.
All right, we're going to do one more, and then we're going to bring Mark up because I know he's got a lot to say. Dog Balt Ag 3168. That was horrible, but we're speed questioning here. Andy, in your interview last week with Kyle, you spoke briefly about, quote, hedging to cover your purchase of several million in gold. I just don't understand.
So
it's a good question. I say we always get these questions, and we have to do the rudimentary so that the people do understand. Because if you don't understand with the hedging aspect, you won't understand why premiums and things move the way that they do.
So if I have, it's probably easier to understand with silver. If I have 1 million ounces of silver in my warehouse and silver falls by, $5, I'm out $5 million. You can't stay in business in an industry where margins are 2% or less.
Especially these days with volatility being where it is.
So you can't do that. You're out of business quickly. You can't speculate with your inventory. So if I have 5 million in inventory, I'll sell 5 million on COMEX. If the price fell by $5 on my inventory, down 5 million, it goes up on what I sold short the exact same amount. Allows me to be market neutral in my positioning of the inventory. I don't speculate with inventory. That's exactly what I meant. And that's why the rising margin costs of over 300% into January screwed the industry up so bad.
Rising prices are not always the biggest danger. Rising costs inside the system can break dealers first. What Andy Schectman is highlighting is that hedging protects inventory value, but margin spikes above 300% can choke even neutral positioning. That exposes a contradiction many retail buyers missed. Volatility is not only about spot price, it reshapes who can stay liquid. If supply chains tighten while premiums remain unstable, ordinary buyers pay for structural stress long before headlines explain it. Next, Andy Schectman unravels why risk can rise even when dealers avoid speculation.
The only thing that we actually can't hedge, as a dealer is the premium. So as Andy said, if we had bought 1 million ounces of silver and they happened to have been Eagles, and the premium that we bought Eagles at, let's say at $6, and then the premium on Eagles had fallen by $2, we eat that. That's a $2 million loss that we can't hedge. So that's the way it works. It's a lot of intricacies, but for the most part, that's kind of how it works. So we hear all these numbers from Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs. What we really want to know is the numbers out of Redbrook Management. Where are we going to see the end of the year gold and silver numbers?
Michael Oliver's saying $500 silver by this summer.
He's saying 300 to 500 by the summer.
Just listen to
and and by the way, he's adamant. He's steadfast, even with these downturns. He believes
this summer. He said this summer, $500
June.
silver. I heard him say that on Adam Tager yesterday.
Oh, he's beyond adamant. He's
put him on the spot. What do you think, Mark?
You're on the spot. What do you think?
I think in the short term, the move down isn't quite over, so we'll get a little bit more of a move down. So call it I think it's a 5, maybe 10% type of a move left, and then I think year end I'm closer to silver 100, let's say, and gold's like in the 6,000 area. So I'm bullish, and I think longer term silver 200 is very doable.
A bullish market can still punish anyone buying the wrong form at the wrong premium. Andy Schectman's argument suggests the real blind spot is not just metal direction, but premium compression that cannot be hedged. A $2 premium drop across large silver inventory can erase millions even before spot shifts matter. That forces disciplined investors to separate price conviction from entry structure, because timing and product choice directly affect preserved capital. Next, Andy Schectman reveals why aggressive upside forecasts often ignore this hidden cost layer.
Again, the reason I use 200 is because I think at that level, at least for now, you can start to recycle some silver out of solar panels. So there's some supply. Again, that could change, but I'm a big fan of, the $600 silver numbers, 500-600. But I think I need to understand how that supply situation works first.
Well, Mark, I always say that, it's very difficult. I think it's impossible actually to get to 500 or 600 before we get to 100 or 200. So,
exactly.
I mean, listen, I've known you for a long time.
That was good. That was like fortune cookie-ish.
Yeah. I mean, it is impossible, right?
Yeah.
Would you talk about gold and silver ratios and how your company would
I answered that
receive
question
silver
on
in
Jared's
exchange
show
for gold?
today.
Yeah.
It's interesting because if you look at the analyst from Bank of America, their head metals analyst who talks $300 gold, silver potentially by the end of the year, uses the silver gold ratio as his guide. And Michael Oliver, with his $500 silver call by summer, uses the ratio that it's imbalanced from a historical standpoint. It's at 60 to 1 right now. It's averaged about 40-ish, 42 to 1 for a very long time, for the majority of the time over the last 150 years. But when that time comes, if it's in an IRA or in a storage facility, it becomes very easy. If it's not in an IRA, it's in your possession.
Extreme targets sound exciting, but ratios usually reveal where reality pushes back first. This is where Andy Schectman's thesis shifts towards supply mechanics instead of pure price optimism. A gold-silver ratio near 60 to 1 versus a long historical zone closer to 40 creates tension, but reversion is rarely linear or painless. For wealth protection, the bigger issue is whether physical access, taxation, and storage flexibility align before any major repricing. Next, Andy Schectman exposes why ratio logic can still collide with real-world supply friction.
We'll lock in both sides of the order simultaneously, send you FedEx air bills, as I told Jared this afternoon, and help you ship it back, and then ship you back your gold. It's literally that simple.
And I would say almost the majority, unless you're holding on to 5 1,000-ounce silver bars or 3 kilo gold and 100-ounce gold bar. We're not reporting to the IRS. Of course, you as a law-abiding tax-paying citizen, that is your obligation to do that, but we're not going to report it on a 1099-B.
Yeah, and I just think all the volatility we've seen in silver meshed with the deliveries by the most sophisticated traders in the world betray the price rhetoric. And as I said on Jared's show today, any asset that is repricing itself won't be orderly, it'll be chaotic. And that's what we're seeing right now. There will come a time to make that trade. For those who bought in March of 2020, it was 120 to 1. It's now halved. So you could get twice the amount of gold you could buy then. But I think you'll see it drop considerably. That would be the thesis that both Michael Oliver and the lead analyst from Bank of America.
Yeah, I mean, look, I think we talked about it. And last week I said that, I think we're going to wake up one day and we're going to see silver up $5-10. Last week we did see silver make a surge, and we were at $89. I mean, we were teetering on 90, and then bam, smoked us right down.
But there is someone buying it.
Yeah.
Markets can look disorderly long before real positioning becomes visible. As Andy Schectman points out here, the deeper signal is not volatility itself, but how sophisticated buyers continue taking delivery while price action remains chaotic. A ratio that has halved since 2020 tells you relative value already shifted, while retail still stares at headlines. For wealth-focused investors, repricing rarely arrives cleanly. It punishes hesitation and rewards understanding structure over noise. Next, Andy Schectman reveals why visible volatility may be hiding deliberate accumulation.
They're not letting it drop out of the 70s. So that's support.
Yeah. For now, it's support. Like Mark said, it could fall further, but I feel like this time is different. I think that we've traded enough here in this level. When we first saw silver skyrocket, go parabolic from December to January, we talked about it. We said it's not going to continue like this. Everything that goes up like this has to have a downturn.
Well, and don't confuse rising rates with an inability to own metals, because rising rates, if the currency was strong and stable, fine. currency is anything but strong and stable, and the fiscal irresponsibility of our administration is historic. And so when you talk about rising rates into a currency that nobody wants to hold, or treasuries that no one wants to hold, it's really, if you go and look at how gold moved all the way up, it moved up in 1980 into rising rates.
Right.
It wasn't until Volcker raised rates to 18%
Yeah.
that he was able to squash the gold bull. Can you imagine what 18% rates would do to this economy?
Oh my Lord. I mean, no.
Let's take a few more questions.
Yeah,
5
and
more
then
minutes.
we
and
got-
I'll bring on Jared.
Yeah, we only got a couple of questions, and we got to get Jared on. Let's see. Echo Leaf 00. What do you think of 1/10 ounce gold pieces to stack? Should I stick with quarter ounce and half ounce? If you're going to do fractional, actually for me, I love the 1/10.
Rising rates are supposed to calm inflation fear. Yet weak currency confidence can reverse that logic fast. Andy Schectman notes the overlooked pattern is that metals can rise even when yields climb if trust in fiscal discipline erodes underneath. The historical echo matters. Policy tightening only works when markets still believe the currency deserves patience. For savers protecting purchasing power, this is not a Wall Street puzzle. It decides whether safe assets quietly lose real value. Next, Andy Schectman exposes why rising yields can still strengthen the case for hard assets.
They're pretty much my favorite in fractionals. I guess it's
Mine
probably because
too.
I was taught by you.
I love the 10.
But they're the greatest. I actually don't even look at halves, to be honest. To me, I'm either going to go 1 ounce or I'm going to go tenths.
Yeah.
That's pretty much the way I stick to it.
whether
I own them.
whether you're playing poker or living life or driving on a crowded highway, you can never have too many outs or exits or options. The 1/10 ounce Eagle is by far my favorite choice. There's a hefty premium, but I will say this, that it's the one gold item above all else that has maintained its premium my entire
No doubt.
career. There's big demand for them, so I like them.
No question. Rates have gone higher, which I think is probably one of the biggest reasons why we're seeing metals move the other way, although it shouldn't be.
Japanese yield, I think 10-year 2.7 or 8%, the highest ever.
Yeah, and I think the United States, this is the first time that we've seen these numbers since what, January of 25, I think was the last time.
Every 1 basis point, so there's 100 basis points in 1%. Every 1 basis point adds $3.9 billion in borrowing costs annual to the U.S. government. The Doug Casey put out a great article just earlier this afternoon talking about how the 10-year Treasury is like the heartbeat of the global financial system. And when you see rates on the 10-year moving up 65 basis points since the beginning of the war, that adds $30+ billion to the 180 billion, almost $200 billion to the annual cost.
Markets may celebrate higher yields, but debt math often gets uglier underneath the applause. According to Andy Schectman, each basis point rise carries hidden cost pressure that compounds faster than most households realize. When borrowing costs swell by billions while central banks still defend stability narratives, the contradiction becomes hard to ignore. For disciplined investors, flexibility and liquidity in physical holdings matter because policy stress can ripple into premiums, rates, and confidence together. Next, Andy Schectman unravels why rising yields can become a fiscal warning, not a strength signal.
Over $200 billion to the annual cost that the government has to pay to finance its debt. And when you see the 10-year yield moving up, not only does it cost the government much more, it's a sign that the dollar's in trouble, that countries are selling treasuries. And that's an unusual thing, man, because every war I've seen that involved oil, every single one, you see rates go down because bonds are being bought as the 10-year ultimate safety vehicle. And it's not viewed that way anymore. It's a big deal when you see rates moving up, not just in the US, but in the UK and in Japan and across the G7. It's a bad thing.
Yeah. I mean, look, I think, and you know what, I just had a bunch of my notes for tonight and I just looked and it was actually, I'm now looking and it's April 22nd. So, and then of course, the next thing I have is the Fort Knox being audited. And did you catch that clip of Trump?
Yeah.
About Fort Knox?
Yeah.
And he says, I sure hope it's there. And when I started doing a little bit of deeper dive into the Fort Knox audit, and the last time it was done, it was in the 50s. the majority, I think it was 60% of all the gold that's held there are non-standard.
Yeah, it's because they're coin melt.
Yeah. I mean, you're talking, they said that the purity, the majority of them
90.
are about less than 90.
Yeah, that's why
Yeah.
London didn't take bars. I mean, France didn't take bars
Yep.
back. They sold them in 3 or 4 tranches.
And then rebought it. Yeah.
And when you talk about what gold does, even though it's had a little bit of a correction,
Bond markets usually absorb fear. But when yields rise during geopolitical strain, something deeper may be shifting. What Andy Schectman is highlighting is that sovereign selling pressure can challenge the old Treasury's equal safety assumption. If rates climb across the G7 instead of falling into panic demand, confidence in traditional refuge assets deserves scrutiny. For conservative investors, that means diversification is not theory. Concentrated trust in one narrative can become expensive fast. Next, Andy Schectman reveals why weakening bond behavior may contradict decades of safe haven conditioning.
what it does is it travels with real yields. So he just called me too.
Yeah.
So rates are going up, but the real yield is still negative. When you look at a 4%, 4.5% on a 10-year Treasury, the government purposely understates inflation. They understate inflation so that the real yield is actually negative. The nominal yield looks positive, right? Inflation at 3.5 that they say, and the yields are at 4.5, still positive. But that's why they're trapped. If the rates keep rising, there's no way that they can lower rates on the front end of the curve. They can't, because it's just going to signal that they're giving into inflation. They're going to reignite it, and investors will demand, especially if the yields get actually below the real level of inflation, or the nominal level of inflation, the stated level, which is fugazi. Who in their right mind would buy a Treasury with any duration right now? And that's what you're seeing. You've seen the 10-year being sold off. The 30-year above 5%. It hasn't been there since right before the great financial crisis in late 2007. Bad sign, ominous.
It's ominous. That's a good one. And by the way, I think, tonight we have a special guest with us who I think can kind of cover a lot of different aspects. And we get asked so often about miners, because that's a big thing for our audience. And we brought someone out here that has his own management firm. He's a portfolio manager. I've known him for a long time. He's an extremely, extremely bright man. And I'm when we bring him out, you tell me when. I think that we're going to get a nice little eye open with a lot of things that he has to say.
I know he wants to talk about how negative real rates are a problem. And that's what gold sniffs out. It sees through the nominal nonsense. And
it gets through the bullshit, the forest through the trees,
yeah,
as we like to call it.
Yeah. Thank you very much for that. Peter Grandich, I did that interview with him this morning. I can't believe he posted it already. It's kind of a tough interview with Peter, because he says to me, just go. He doesn't ask me any questions. And so,
well, by the way, you have no problem just go.
Yeah, but I mean, I have to think on the spot. What the hell am I going to talk about? I didn't know he was going to do that. So it's tough, but he's an amazing guy.
Yeah.
Nominal strength can mask real erosion until investors realize yield is losing to purchasing power decay. Andy Schectman's argument suggests the deeper trap is policy optics. Rates may appear restrictive while real returns stay pressured underneath inflation reality. When long-duration bonds weaken near levels less associated with major financial stress, markets begin questioning narrative control. For wealth preservation, understanding real yield matters more than headline percentages, because false comfort can lock savers into shrinking value.